Good evening and welcome to this Teagasc webinar hosted by the Teagasc Farm Management Department. My name is James McDonnell and I work as a Farm Management Specialist in the Farm Management Department of Teagasc, and I will be chairing this webinar tonight. We have two speakers tonight, both of whom work with me in the Farm Management Department. Our first speaker, Ruth Fennell, will speak to you on the topic of Department of Agriculture Registered Farm Partnerships, and our second speaker, Klara McGriskin, will take you through a real farm family succession plan and how a registered farm partnership helped them achieve their succession plan. During this webinar, you can submit your questions at any time via the Q&A function at the bottom of your screen. Your questions can only be viewed by the panelists on this webinar. The questions will be dealt with at the end of the webinar. We're scheduled to finish at around 8:30, but there is a possibility that it might run on a little bit longer, so please bear with us. It's being recorded, so you can view it again on the Teagasc website. So all you need to do is log into the Teagasc website tomorrow or the day after when we have it up there. And if you have to go early, you can see the remainder of it. But if you have some questions, put them in, and even if you don't hear the question being answered, you'll get it on the recording. The running order tonight, our Teagasc Collaborative Farming Specialist will speak first. Department of Agriculture Registered Farm Partnerships is one of Ruth's specialist areas of work. She will make a presentation on how to prepare an application to set up a registered farm partnership. Then Klara McGriskin, the Teagasc Farm Management Specialist, will present a real example where the family used this partnership as part of their succession plan. And Klara will concentrate on the capital taxes aspect of the transfer also. I'd like to thank both our speakers and yourselves, the audience, for participating tonight in case I don't get to do it later on. And I hope that you find it useful. So our first speaker tonight is Ruth Fennell. Ruth previously worked as a dairy advisor in Dungarvan and a dry stock advisor in Middleton, so she has real experience of dealing with clients and the benefits of registered farm partnerships and what they have bestowed on farming families. And before I hand you over to Ruth, I'd like to remind you to submit your questions using the Q&A function again. That's at the bottom of your screen at any stage during the webinar, and I'll pick them up and I'll read them out once the presenters are finished. So Ruth, over to you now. So if you can share your screen, and the floor is yours.
Okay, so as James mentioned, I'm currently working as a collaborative farming specialist with Teagasc, and I often get asked, what does that role entail for you? So collaboration is basically the bringing together of any two farmers working in a mutual arrangement for their benefit. And I suppose partnerships is one of the founding areas of that. And I suppose it has a huge lot to offer. Partnerships were originally established as milk production partners in 2002. And then were further open to those outside of the milk production areas in 2015. And they've been in play and have increased in numbers over successive years. So we currently have about 4,600 registered farm partnerships. The vast majority of those at this stage are probably family partnerships. And in addition to that, we have about 160 succession farm partnerships. And what I'm going to do this evening is just to run through with you some of the benefits and some of the considerations that you might want to take into account if you're considering a partnership, and then how you go about completing that application and the steps that you need to take to do that. So I suppose firstly, we have a look at the collaborative pathways that may be involved. And in this specific side, I'm looking at those parties where they're unrelated and they're looking at collaborative options. So as I mentioned, the partnerships were opened up in 2015 to non-dairy farmers as well too. So it was originally set up as milk production partnerships in 2002 and then opened up to all other farming enterprises in 2015. And we would have seen a number of maybe dairy farmers that would have come together to pool their resources and to work together under the partnership model at its initial inception. Or we could have also seen other enterprises coming together as well since then. So I suppose some of the options when we're looking at doing collaborations with non-family members that might be considered are the registered farm partnership model that we're going to go through this evening, some share farming, and also some long-term land leasing that may have been looked at as another option. And what we're looking at here is where the current farmer may or may not be prepared to step back, where they don't currently have an identified successor, or alternatively, they may have an identified successor, but that individual isn't ready to step into the farming business at that stage in time. And this may be an interim collaborative arrangement to tide them over a period of time, and then they may look at future options down the road. If we then move on to then the family model, and I suppose what the options are available to them. In a lot of cases, what we're seeing is that the registered farm partnership is being an earlier introduction to the farming business, and the successor being earlier identified as having a contributory role in relation to the management and running of the farm. It's often used as a way where the current farmer is not ready at that stage to take a full step back from the farming system, but has a successor that's ready to come and get involved in it. And what we see is this is a much more gradual transfer process. So it allows the younger generation to come in and to find their feet and to work out what works for them. They bring in new ideas and maybe new technologies, but they have the experience and the knowledge of the older generation that have been farming that land for many years. And have been running successful businesses. And together with the formation of the partnership, it allows them to come in and to have their voice heard and to have their share of the profits recognised and their work rewarded financially as well too. In some cases, we'll see that may develop on and the formation of a succession farm partnership where a decision is made to transfer the land on to the next generation. Or alternatively, they might decide to do it as a gradual process over the duration of the partnership without actually going into the formal status of a succession farm partnership. So they both have options open to them as to which avenue that they decide that they're going to take. So what I'm going to go into in the presentation this evening is having a look at in relation to the registered farm partnerships, also covering the succession farm partnerships, and if you wish to proceed and make an application, how you go about doing that. So firstly, on the registered farm partnership. So a registered farm partnership is where we have two or more farmers coming together, where they make an agreement to share their resources so that they can enjoy the benefits such as the economies of scale, the improved work-life balance when you have another partner that can fill in, that knows the running and the management of the farm. And I suppose it takes away some of the isolation that we often find that can be associated with farming. It consists of a minimum of 2 partners, but at least you can have a maximum of 10 partners within it. But you obviously need, in order to form any partnership, you have to have at least 2 people. The partnership financial operations all need to run through a single bank account. And what happens when you're formed a registered farm partnership, your accounts are completed like they normally would have been done. But when we get to the bottom line of the profit share, they are then divided in line with the profit share agreement that has been outlined in the partnership agreement. And everything, as I said, needs to run through that single bank account. So all the single farm payment, all the sales that go through and all the expenses go through that single bank account. And it's important that everything is run through there, because if there is an inspection done at any stage, that's often one of the areas that they will be looking at. Farmers can also avail of a number of financial supports that are aimed at encouraging and maintaining the development of the partnership. And in order to be able to apply for those, the partnership that you have has to be registered on the Department of Agriculture's Partnership Office and on their register. So we would often have questions from people that they tell us that they're farming in a partnership. There's a difference between, say, a tax partnership or a joint venture compared to what we have in a registered farm partnership. And I'll go through that in a little bit more detail with you now. So I suppose, what are the advantages of a registered farm partnership? So we're bringing 2 businesses together into one larger operation. We have a sharing of the workload and a more efficient use of labour on the farm. There's a result of that, an improved work-life balance, and also then the potential to increase the scale and technical efficiency, because you're able to focus on one job in particular. There can be increased farming competencies through utilisation of different skill sets, so that each partner within the partnership will have certain strengths and weaknesses. And it's a matter of trying to focus on each individual's strengths and seeing what they can offer to that partnership. We would also hope that we'd have reduced isolation through the working with another farmer, and the greater flexibility then to allow the partners to take more time off, because you now have somebody that can step into your shoes and is fully au fait with how the business is being operated. It also provides a good business structure for the young farmers to enter an arrangement with an existing farmer who has no identified successor. And we are seeing more interest in relation to these type of models over the more recent times. If we then look at the case in relation to farm families and what can the farm partnership model offer to them, So I suppose it's often seen as the first step in a farm succession plan. So as I mentioned, with the standard farm partnership, there's no requirement to transfer any of the assets, but we will often see that a big gradual transfer of assets will take place over the course of the partnership agreement, as one farmer steps up and takes a greater role in the management of the farm, and the previous generation gradually take a step back and are maybe less involved in the day-to-day running of the farm. It's often where the son or daughter, the nephew or niece are then formally recognised in that farm business at an earlier stage. So it may have been in cases before that the herd number wasn't transferred into the next generation's name until the whole farm transfer took place. And in some cases, that may not have been until somebody passed and it was passing through in an inheritance case. So what the partnership does is it recognises the role that that younger generation is playing, and that it also involves the tax or the income incentives that are there and the financial incentives that are there as well too. So as I said, no requirement to transfer land. We would hope there would be improved work-life balance. There are some income tax benefits as well too, and also the department scheme benefits as well. So I suppose in relation to the financial benefits, it's a great way of maximising the family farm income at the lower rate of tax. So currently each individual can earn up to 44,000 before they pay any high rate tax. So if we have the case of a family farm partnership where we have a father and a mother and a son or daughter coming in on that partnership, that those three members within that partnership could earn up to 132,000 before there's any high rate tax paid. Obviously, the profits that are split in relation to the profit sharing ratio would need to tally with this, and it is a requirement with the category 2 applicant or the younger generation that's coming in on the herd number that they have to be entitled to a minimum of a 20% share of the profits at the formation of the partnership stage. Some of the other advantages then on the financial side of things comes in the form of the stock relief. So young trained farmers, whether they're in a registered farm partnership or whether they go out on their own, are entitled to 100% of the stock relief with an upper limit of 400,000 over a 4-year period and a maximum of 40,000 in any one individual year. And they're entitled to 100% of that on the same ratio as a profit share that's been allocated within the profit sharing partnership agreement. On the other side of the partnership, so for the other partners within the partnership, they also have an enhanced stock relief. So normally that stock relief would be at 25%. In the case of registered farm partnership, that increases to 50% on the same ratio as the profit sharing ratio and up to a maximum of 20,000 over a 3-year period. In relation then to the TAMS grants, there is also a significant incentive there for the registered farm partnerships. So when the registered farm partnership has been issued with their partnership number, they are entitled then to an increase in their investment ceiling under TAMS of 160,000. So normally a single herd number would have a sole trader threshold of 90,000 in a TAMS application, and that's increased to 160,000 in the registered farm partnership. In addition to that, the young trained farmer is recognised and therefore is entitled to claim under the Young Trained Farmer scheme. So the first 90,000 of that 160,000 under TAMS would be eligible at the 60% grant rate. If you also have a female within the registered farm partnership that is not necessarily the young trained farmer, and they were on the herd number in 2022, or if they weren't on the herd number in 2022, but they have a recognised agricultural qualification, the entire 160,000 could then be claimed at the 60% grant rate. So I suppose there's good incentives there for any farm that's bringing on the next generation, and they may have plans then to do some capital investment on the farm, maybe some expansion work, maybe some slurry storage work. So the additional funding is hugely beneficial in relation to that. And I suppose this is one of the major benefits and the partnerships when we compare it to a joint venture. So if a joint venture is where maybe a son or a daughter goes on to the herd number with the parents or the father or mother, they're not recognised in those cases for the increase in the TAMS ceiling, and nor are they able to avail of the young farmers top up the 60% grant rate with the TAMS either. If we then have a look at some of the other scheme benefits that are available there, under the Basic Income Support for Sustainability Incentive, the young trained farmer can apply where they're under 40 years of age and they have joined the farming business within the previous 5 years, that they haven't exceeded 5 years on the herd number, and they can apply for a top-up on their entitlements. In 2024, that equated to €163.08, and in 2023, it was somewhere in the region of about €150. It's envisaged that the maximum payment on that one will be about €175. There's a specific pot of money allocated to that. So obviously, if it's oversubscribed, then there's a pro rata reduction, but a significant payment there. So it's paid out on a maximum of 50 hectares for a 5-year period. And once they've applied before their 40th birthday, they can avail of that for the full 5 years. It equates to somewhere between 8,000 and 8,500, so a significant payment to be able to avail of. The other option that's available is the National Reserve, and that's what that does is it gives young farmers that are on the herd number or on a registered farm partnership the entitlement to look for National Reserve entitlements. Those entitlements come in at the national average. They're applied on ground that has no entitlements already, so what we refer to as naked ground. Or alternatively, if you have low value entitlements that are below the national average, they can top up the value of those entitlements to bring them up to the national average. And that again is on a maximum of 50 payment entitlements as well too. One thing that's very important to note is this is done at a herd number level. So if anybody within the herd number since 2015 has already availed of the complementary income support for young farmers or the National Reserve, and you so subsequently add a new young farmer to the herd number, it's not an option to be able to avail of this for a second time. So this is a once-off application. So if you've already availed of the young farmer scheme on a previous application, on a previous cap round, from 2015 onwards, adding another son or daughter to the herd number or another young trained farmer to the herd number won't increase, won't give them an allocation to either of these two schemes, but it will give them an allocation to the increase in the TAMS funding at the 60% grant rate. So just in relation to then covering some of the costs that might be associated with getting the partnership set up, they have what we refer to as a collaboration grant. And what that does is that applies a 50% grant rate up to a maximum spend of €3,000. So therefore a maximum grant payable of €1,500, where the partnership contains a young trained farmer and where they submit invoices which outline the costs that were involved with the setting up of the partnership application itself. So for each new partnership that's set up, and obviously it's only for new partnerships that they're able to avail of this. And as I said, they need to have a young farmer as part of that partnership application. They will be sent an invitation to apply for the collaboration grant, generally around August time. So the email address that's being used to submit the partnership application will receive an invitation to apply for the collaboration grant. And assuming that they submit their invoices, then they should be eligible to receive that funding for it. So just looking at then as to who's eligible to join a registered farm partnership. So as I had mentioned previously, we're required to have a minimum of 2 partners to form a partnership, and that can go up to a maximum of 10 people. Okay. There's a minimum requirement that you have at least 1 Category 1 partner as part of any registered farm partnership. Then the second partner in a partnership can be either a Category 1 or a Category 2. A Category 1 farmer is any farmer that has farmed for the previous 2 years with a minimum of 3 hectares of utilisable ground. So if anybody has only recently gone on a herd number, they're not deemed as a Category 1 farmer until they're at least 2 years on the herd number. A Category 2 applicant or partner is anybody who holds an appropriate agricultural qualification at a minimum level 6, and they have to get a minimum 20% of the profit share in line with the profit share agreement in the registered farm partnership. You can also have a Category 3 applicant within a partnership, and that's anybody that doesn't meet either the Category 1 or the Category 2 status, but it's only permissible to add a Category 3 partner to a partnership where you already have either 1 Category 1 and 1 Category 2 or 2 Category 1 partners. So you need to meet those minimum requirements initially before you're entitled to then add a Category 3 partner. So just a few words of note in relation to that. A limited company must have been farming for a minimum of 2 years in its own right before it can then join as a registered farm partnership as a Category 1 partner. We've often been asked that question, and if anybody is planning on moving to a company, that company will need to be established for a minimum of 2 years before you could bring in the next a son or daughter maybe, or a nephew, niece, or another partner within that partnership. You cannot be represented twice within the partnership. So it's not permissible to have anybody that's involved in the company and then also listed as an individual within the partnership as well. You also can only be in one registered farm partnership at a time, and existing joint herd numbers. So where we have 2 parties on an existing herd number, only one of those will be able to qualify as a Category 1 going forward. So if you currently have a joint venture where neither of you hold a recognised agriculture qualification, it's not permissible to move that then with just those 2 individual partners to a registered farm partnership. But it would be permissible if one of those parties held an agriculture qualification, because then you would have a Category 1 and a Category 2 partner. So just to give you a few examples, the categories of each partner, I'm looking at a few of the possible examples of the way it could be set up. So on the first line, we have 2 Category 1s, which is permissible. In the second one, we have a Category 1 and a Category 2. On the third line, we have 2 Category 1s and a Category 3. And on the fourth line, we have a Category 1 and a 2 and a 3. And as you can see, it's only permissible to add the 3. So we can't have a 1 and a 3 or a 2 and a 3 until we've already met the initial requirements of the 1, the 1 and the 1 and the 2. So just to go through a few examples here of how some scenarios might work. In the first example here, we have John Murphy, who's been farming solely on his own with 50 hectares for the last 10 years. His son James has just completed his level 6 agricultural qualification, and John has been farming for more than the 3 hectares for at least the previous 2 years, and he therefore qualifies as a Category 1 applicant, and he's eligible then to form a registered farm partnership if he so wishes with his son James, who will come in as a Category 2. And James must be entitled then to a minimum of 20% share of the profits in that registered farm partnership. In this example here, the profit sharing split is being divided up on a 75-25 basis for John and his son James. If we then have a look at a further scenario here, and this is where we have 3 family members coming in to form a registered farm partnership. So once again, we have John Murphy, who's been farming the 50 hectares for the 10 years. And again, his son James, who's just completed his level 6 qualification. We also have John's wife, Joan, who works off the farm as a primary teacher, and she jointly owns some of the recently purchased lands and helps out with the calf rearing and paperwork on the farm. So given that John has been farming for the 2 years and more than 3 hectares, he's our Category 1. We have James then, who's coming in as our Category 2 with his level 6 qualification. And given that Joan wasn't previously out on any herd number on her own, she's now coming in as a Category 3 applicant, and that's permitted because we already have a Category 1 and 2 partner within the partnership. In this example here, the profit share is being divided up on a 75, 20 and 5 basis for John, James and Joan within the partnership. So then to just go through a few of the details in relation to a succession farm partnership. So this is very similar to a registered farm partnership. Anybody that's going into a succession farm partnership needs to already be in a registered farm partnership, or has to apply for a registered farm partnership at the same time as well too. The difference between the two is that as part of the succession farm partnership, there's a commitment to transfer assets as part of the partnership agreement. And the way that this works is that when the succession agreement is submitted, they make a commitment that a minimum of 80% of the agricultural assets or the farm assets are going to be transferred at the end of year 3 and before the end of year 10 within the succession agreement. And that will be outlined as part of the application that's submitted to the department. Some of the benefits that you get from that is in relation to the tax credits. So you'll get all the other benefits that you have within the registered farm partnership. But in addition to that, where you go for a succession farm partnership, there's tax relief of €5,000 per year, up to a maximum of 5 years, up until the year prior to the young farmer turns 40 years of age. So a total tax credit, assuming that he doesn't turn 40 before the end of the 5 years, of 25,000, and that's split in line with the profit sharing ratio, and is also can be used against off-farm income as well as part of the application. As part of the Succession Farm Partnership, you're required to submit a certified business plan, which is a Teagasc My Farm My Plan, and they'll be issued with a certificate to say that that's been completed adequately, and that goes in as part of the Succession Farm application. And it's really important, as I mentioned, the fact that the assets cannot be transferred for the first 3 years of the succession plan having been submitted, that the age of the young farmer going into this, if you plan on availing of the stamp duty at the young trained farmer 0% rate, they would want to be under 32 years of age before you enter a succession farm partnership agreement, as that allows the young farmer to receive the assets of the land and still to be able to claim the 0% stamp duty relief. Obviously, if that isn't an option and they've already gone over the 35, there are other reliefs there that Klara is going to go through with you in relation to her presentation. But if you are looking to claim the 0% stamp duty relief, the succession partnership should be entered into before the young farmer is 32, and it allows then the assets to be transferred and to still avail of that relief. So any of you that have made the decision that you're hoping to look in relation to going into a family farm partnership, how would you go about proceeding from here? So I suppose the first thing that should happen is that the family or the possible partners, if it's a non-family partnership, need to sit down and have a look and to basically iron through some of the concerns that any parties might have as to whether the partnership is the right avenue for them to take, and it's the right plan that they want to make in relation to the farm business structure. And as I mentioned, if there is any changes or any possibilities of moving to companies, or if there is a younger generation that has any interest in doing any foreign travel, all of those things should maybe be done first before you make the step about going into a registered farm partnership. So you've made the decision as two parties coming together that you wish to form a partnership. I suppose the next point then is to probably meet with your agricultural advisor to just determine that you are eligible to form a partnership, that you're meeting those requirements of the Category 1 and 2 or 2 Category 1 partners in relation to forming it. And just to check to see if there's any other possible implications that may be happening there as well too. The next then is to arrange an appointment with your accountant and solicitor and to discuss the proposals and determine if the implications, what some of the implications are from a tax point of view. So we have had cases where we've had young farmers wanting to get involved on the farm business, but where they have a considerable off-farm employment and they're already at the high rate of tax themselves, they need to be aware of any of the profits that they then take from the farm is going to be paid at the high rate tax then as well too. So it's a matter of taking all those considerations in board and seeing what the best way is in relation to your individual scenario as to how you should proceed on that front going forward. So I suppose if the decision is then made to proceed, your accountant will apply to revenue for a tax reference number for your partnership, and that needs to be submitted as part of your partnership application. The herd ownership name needs also to be changed to the members of the partnership. So if the current herd number is in the name of Jim Brown and you're going to add your son James to it, it'll go to Jim and James Brown. So that requires the submission of an EOR1 form to go to your local DVO office. There's a new EOR1 form that was produced by the Department of Agriculture there in December. We have links of that up on the Teagasc website. There's a little screenshot of it up there on the right-hand side, but there is a fair bit of paperwork that goes in with that application. So you not only do you need copies of the folios and the deeds or copies of leases to go with it, but there is a good bit of information that needs to be filled in that. So if anybody is considering doing registered farm partnerships for this year, that should be one of your first items on the to-do list, is to get that EOR1 form submitted to the Department of Agriculture. In addition to that then, as I previously mentioned, that all the finances for the partnership need to go through the single bank account. A bank account needs to be set up and opened in the names of all the partners within the partnership, and they have to be listed on that bank account. So generally banks are not able to add a name to an existing bank account, so it will involve opening a new bank account, and all of the transactions will then have to be run through that partnership bank account going forward. So some of the other documents that need to be completed. So we have a section up on the Teagasc public website that's under the collaborative farming section, and all of the documents that we're going through with you here are available for you to download, the templates of those that can be used to submit your partnership application. So we have the partnership application, and what that does is it lists all the partners and their associated category, and that partnership application is going to be signed by all parties within it. It includes the names of the partners, the land that they're bringing to the partnership, whether it's owned or leased, the financial contributions, whether that's cash, livestock, machinery, feedstuff, fertilizer or other that they're bringing. And it also outlines the split of the division of the profits in relation to the profit sharing ratio. If there's anybody that is a co-owner of any land and they're not involved in the partnership, they also have to apply for an exemption to stay out of that partnership. So that form needs to be completed as well too. So we have the partnership agreement, then we have the on-farm agreement. And what the on-farm agreement does is it outlines the day-to-day running of the farm, how the duties are going to be assigned and how the farm is going to be run on a day-to-day basis. And there are a number of professionals that will also be listed on that. So the bank that you're dealing with, the accountant that the partnership is going to be involved with, and the solicitor that has been assigned to help in relation to any of the partnership legal issues. And also the bank account form. So as I mentioned that the bank account needs to be opened, there's a form then that's signed by the bank and stamped by them to just state that partnership bank account is now operational. So just a checklist of some of the documents that are required. So for the registered farm partnership, we have the completed checklist, the application form, the partnership tax reference number that your accountant will be able to apply for you from revenue, the completed bank details form, the fully signed on-farm agreement and partnership agreement, copies of the folios for all owned land, copies of the leased for leased land, stamp duty certificate from revenue for any of the leases that are there. And if we have a young farmer coming in as a category 2, we need evidence of his agriculture qualification. If a decision is being made then to go to a succession farm partnership, there's a separate application for the succession partnership. We also have the completed legally binding succession agreement. We have the certificate for the My Farm, My Plan business plan, and you also must submit the birth certificate for the successor as well too for proof of age. So if you're looking for any further information, Teagasc have produced a booklet with the guidelines to forming a registered farm partnership, which goes through all of the details that I've outlined in the presentation today. In addition to that, there's a section on the Department of Agriculture's website under gov.ie, and there's all the registration documents that are required under that section as well too. And as I mentioned, there's a large section on the Teagasc public website where you'll be able to get all of the templates and some examples and a good bit of information in relation to that. And if you have further questions, you can either go through your advisor or also the Farm Partnerships Office are available to answer queries via the Farm Partnerships email address that you can see on the bottom of the screen. Okay, thank you.
Thanks, Ruth. You went through a mountain of material there in a very short time. And just while Klara is getting her talk up, I might just ask you one question, Ruth, if that's okay.
Yeah.
The benefits of the Registered Farm Partnership. Some people go down the route of forming a joint herd number. And I suppose, in a sentence, what's the main difference between a joint herd number or a joint venture, as some people call it, and the Registered Farm Partnership?
Okay, so with the joint venture, it's purely just adding someone to the herd number, so they can apply for the complementary income support for young farmers, and they can also apply for the National Reserve, but they're not eligible for the TAMS young farmer unless they're solely on a herd number on their own. They are not recognised if they're on listed with somebody else unless they all meet the young farmer criteria, and they're not eligible then for the increase in the TAMS funding that comes in at the 160,000 rate.
So there's a big benefit, so Ruth, in forming the Registered Farm Partnership.
Yes, certainly, especially where they're going to be doing any development work on the farm. Do you know, and that's often the case when the next generation is coming on. We would often see that there's capital investment made. And I suppose the increase in the TAMS funding and the fact that they get the first 90,000 at 60% is a big benefit for that. Yeah.
Yeah. There are some more questions, but I'll get to them when Klara is finished. So thanks, Ruth, for that. We'll give you a break. So tonight our second speaker is Klara McGriskin. So Klara works with myself and Ruth in the Farm Management Department. And Klara's previously worked as an education officer in the Thurles office and also as a dry stock advisor in Carda. So Klara is now going to take you through a real case study of a farm family who used the Registered Farm Partnership as a stepping stone in their farm succession plan. So over to you, Klara.
Thanks, James, and good evening, everyone. So, like James said, this is a real life case. Obviously, we have anonymized the names, but this is a case that we dealt with in the farm management side. And I'll just go through it and I'll emphasize, because the topic this evening is on partnerships, how forming a partnership helped this succession plan. So we have the Kelly family, and I'm going to go through their story now. So we have Tom, who is 68, and Sheila, who is 65. So they have retired from their off-farm employment, and they're both receiving the state pension. They would like to stay involved in farming and need additional income to support their pension income. Okay. So the background to the farm is that it's a 75-acre beef and sheep farm. It's 2 blocks, the home farm, which is 48 acres, and the outside block, which is 27 acres, and it's 4 miles down the road. So the home farm came from Tom's side of the family, and the outside block was inherited by Sheila from her uncle. And they are currently farming under a joint herd number. So it's Tom and Sheila Kelly on the herd number. They have 3 children. The third child is Mark, who's 28, and Mark lives in Dublin and works as an engineer, but has absolutely no interest in farming or moving home. They also have a daughter, Julie, who's 30, who lives at home, and she's teaching locally, and she got engaged last year. And they have Brendan, the first son, who is 33 years of age. Brendan lives at home, but he works full-time off the farm in construction. He helps out at evenings and weekends, and he has his green cert completed. So we're going to go through the thoughts and concerns of the parents now on their thoughts and concerns before they develop their succession plan. Okay, so their thoughts would be that they have firstly identified Brendan as the successor of the farm, but they're thinking now, do they transfer the land to Brendan now, or do they leave it till down the line? They want to give a site to their daughter Julie, who wants to live locally, and even though Mark doesn't have any interest in the farm, they want to be open and inclusive of Mark in the planning conversation, even though he is away working in Dublin. Their concerns is how to give Brendan more responsibility but remain involved in receiving an income in the farm. Brendan will be 35, he's currently 33, in 2 years' time, and it could be more expensive to transfer the farm to him then. Julie also inherited a house from her aunt up the country previously, and it's thought that this could jeopardise the tax liability. And they feel that Mark might be feeling left out of the succession or planning conversation. So that's from the parents' point of view. So from the children now, what's their thoughts and concerns? So Brendan wants to be more involved in the farm, and he wants to improve the farm through applying for TAMS and the Young Farmers schemes. Julie would like to build a house near her home and be near her parents. And Mark wishes, or he thinks that the parents should have a good quality of life and can visit their home freely. So what he doesn't want is that they hand over their house, their main residence to one of the kids, and then something happens and they won't have access to their home. The concerns of the children would be Brendan's concerns would be that the parents might not agree on how the farm should be run and where Brendan would like to build the new housing facilities. Julie's concern is that Brendan may want the site she has in mind. And Mark's concerns is that the parents may not have sufficient income and that the farmhouse may be transferred with the farmland. So what did we do to address all these thoughts and concerns, and how did we build a succession plan? So there's a new concept developed in Teagasc in the last few years, and it's called succession teams. So basically, from our transferring the farm clinics, we found that the one thing that that people were very frustrated about in the whole succession planning thing is that they were going to their accountant for an appointment, and then the accountant would send them to the solicitor, and then maybe the solicitor would go back, you'd have to go back to the accountant, vice versa, and to all these different professionals, even the farm advisor. And getting these appointments take time, and sometimes you can't get them when you want them, so you have to wait, and it drags out the planning process. So the concept was designed in Teagasc that we create a Teams meeting. So this can be in person, usually, preferably, that the majority of people are in person around a table. And who you would have around that table is that you have your accountant, your solicitor, your farm advisor, the entire family, and the main farmer as well. And you get one meeting together, firstly, the first meeting, and you would talk everything out, the plans out, and what best way to go through your succession plan, and what everyone wants, and things like that. And then you would reconvene, and everyone would come back maybe another day after they had thought about everything. And this can go on for a few meetings depending on how complex your plan is. But usually after the second or third meeting, there should be a fairly solid plan in place. So that's what we did with the Kelly family and the outcomes of this war. So Tom and Sheila were advised to update their wills as they transfer the assets at each stage, to ensure that they have a fallback plan in place in case either of them die in possession of assets. So as they make any changes, firstly, what they were advised to do is update their will now, currently, to today. And then as they make any changes to any assets, they have to update their will as they go along. It was also suggested by the accountant to transfer the outside block. So remember the 27 acres that Sheila, the mother, inherited from her uncle. So transfer that to Brendan now, before he turns 35, to avoid the stamp duty. And I'll go into all the capital taxes now in a few minutes. It was also recommended by the Teagasc advisor that Brendan apply for his own herd number on this land, so the 27 acres, and then enter a multi-herd partnership with Tom and Sheila. So Tom and Sheila would be on one herd number and Brendan would be on another, and they would form a partnership. This would allow Brendan to have his own land within the partnership, and Brendan was going to be very pleased about this. The solicitor advises that the remaining farm assets be transferred in 5 years' time, before Tom and Sheila might need nursing home care, and to protect the farm from this. And the accountant also explained that Julie's existing gift of a house will not have any major tax implications if she was to receive a gift of a site from her parents. And Mark feels assured that his parents have sufficient income in the retirement, and he really values being involved in the discussion of the future of his childhood home. So that is the plan, and all this has to be implemented by the professionals here, your solicitor, accountant, and your farm advisor. So the family are very happy, so they go away and they start implementing this. So when they go to their accountant, the accountant now is going to speak to them about all the capital taxes. So we're going to get into that now. So I'm going to explain what you need to know. So this will be a foundation of knowledge that you will have now in your succession plan, or as you now go into a partnership with somebody, that you know where down the line you stand. And it will give you this foundation of knowledge that when you go into your accountant or solicitor or any other professionals, you will have a knowledge of what these are. So am I going to pay any tax? Nobody wants to pay tax, so we're going to show you ways around paying it. Okay, so the mother is the transferor. So we're talking about the 27 acres, the outblock of land. That's what we're going to transfer now at the moment. Okay, so the transferor is the current owner of the asset, who is the mother, Sheila, and the transferee is the receiver of the farm assets, who is Brendan, who is 33 years of age. So the transferor, so the mother, Sheila, what taxes apply to her? So the main one she has to worry about, I suppose, is capital gains tax. Okay, and the transferee, who's the receiver, who was Brendan, the son. There's two main taxes you have to think about when you're receiving the land. It's capital acquisitions tax and stamp duty, okay? So in this case, Sheila, she is going to be subject to capital gains tax, but Sheila is going to claim retirement relief to avoid this. And Brendan is going to claim agricultural relief under capital acquisitions tax. And at this stage, because Brendan is 33, he can claim young trained farmer relief. But we will also be speaking about consanguinity relief as we go forward, just to show you where that fits in as Brendan hits over 35. So the capital gains tax from the mother's perspective. So currently at the moment, without any reliefs, Sheila is subject to a capital gains tax of 33%. So what does that mean? And where does it apply? So the transfer of the land takes place where the owner is alive is transferred by gift or by sale, okay? The transfer of the capital assets such as land, buildings, and basic payment entitlements, it does not apply to livestock or machinery, okay? So this applies where the owner is alive, it's by gift or by sale, and it's on assets such as land, building, and your basic payment entitlements, okay? So capital gains tax, it taxes the gain in the value of an asset at 33% of the gain. So this is an example of capital gains tax where there's no relief applied. So on this 27 acres currently as it stands, it was acquired from Sheila's uncle at 90,000 euros. So the same 27 acres that she's going to gift now to Brendan, or if she sold it to anyone, is now valued at 220,000 euros. So that's a gain, the 220 minus 90 is a gain of 130,000 euros. So that is where the tax is applied. On that 130,000 euros, we get 33% of that. So Sheila's tax liability currently is 42,900 euro. So it's a hefty bill there to have to transfer 27 acres. So how do we get out of this? So we're going to check, is there tax relief available? And there is for Sheila, who is 65. So Sheila is going to claim retirement relief. And the first thing I always mention when this comes up is that you do not have to retire after availing of this relief, okay? So it's important that people know this. So there is a few conditions though that you must meet. Firstly, you must be over the age of 55, okay? And you must have owned and used the asset for the last 10 years, okay? So what does that mean? So firstly, your name must be on the deeds or the folios for that piece of land. And in this case, it is Sheila's name is on them because she got them transferred from her to her uncle, and she has used the land. How do you prove that Sheila would have used the land? She's on the herd number, the BIS, which we currently call it, the previous BPS or the single farm payment has been submitted with that land under a joint herd number of Tom and Sheila. And that proves that Sheila was involved in the farm the land was in, so she can prove that she used it. So Sheila has owned and used the land for the last, we don't state how long in this case, but I know it's well over 20 years in this case. So she meets that criteria as well. And she's 65, so she meets the age criteria. The trialed transferee, so Brendan, though, must retain the assets for at least 6 years to avoid a clawback relief. So Brendan, if Sheila avails of this relief, Brendan must hold that land in his name for at least 6 years. And if the land is valued at over 10 million, that 6-year period extends to 12 years. Okay, so there's different thresholds here. And from the 1st of January 2025, the child of an owner, so if you're aged between 55 years of age and less than 70 years of age, you have an upper limit of 10 million, which is excess chargeable to capital gains tax. If you're over 70 years of age, though, your upper limit is 3 million. If you transfer the land, say by sale, say if Sheila in this case was to sell the land to a neighbour, that would be the category of any other person that would fall into. So Sheila is between the age of 55 and 70 because she's 65, and the full relief is only up to 750k. So 750,000, and that's a lifetime limit. But if Sheila was over 70, her full relief would be up to 500k. These are the old reliefs, so I'm not going to get into them. But this is from the 1st of January 2025. So other capital gains tax reliefs. So if you don't fall in or retirement relief isn't available to you, there's other reliefs. So there's an entrepreneurial relief, and this is quite similar in that it gives a relief of capital gains tax rate to 10%. So instead of 33, you're paying 10 from the gains of disposal qualifying business assets. This is reduced from the normal rate of 33%, but there's a lifetime limit of €1 million on the gains that you can claim on. There's an annual exemption every year for €1,270. Indexation relief is also there. It's a historical relief, and we don't normally get into it in Teagasc because it applies to very little people. But it may apply to you if you fall into that category, if you've received land in between 1974 and 2003. There's also site-to-child relief, and now this applies to Julie, the daughter. So if the site was down on the out farm where Sheila currently owns, Sheila can give Julie a site there tax-free, no problem. Okay, there is conditions that you have to meet with that, the size of the site and things like that, but your accountant or solicitor will explain that to you better. But they can give, or she could give, or Tom could give, it was on the main block of land because her father, no problem to given the site to child relief for Julie, so there'll be no capital gains tax on that. There's principal private residence relief, and then there's relief between spouses. So we're going to move on now to Brendan. So Brendan's, from Brendan's side, he's two taxes to consider. So the capital acquisitions and the stamp duty relief. So Brendan firstly is going to look at capital acquisitions tax. So this also is applied at a rate of 33%, and where it applies to is to gifts. So in this case, he is getting gifted from his mother the 27 acres, okay? Or it can apply in inheritance, okay? So where this is where the land transfers either by will or on the death of the transferor. It applies to the total value of the land, buildings, direct payments, and other assets received less any consideration to the transferor, okay? And there is tax-free thresholds and reliefs available, okay? So at the moment now, every transferee is entitled to a tax-free threshold, and you would have seen in the last budget these got increased, and it was very welcomed. So these tax-free thresholds depend on the relationship to the transferor, okay? So in this case, the transfer is from mother to son, and all the acquisitions within the transferee's lifetime and within the threshold are grouped. So if or when Brendan receives the land from his mother, that is one transaction, and that the value of that transaction is then accounted for in this one transaction. Anything after that, they are all grouped if it's from a parent. So if the father, Tom, decides to transfer some land, that will also have to be taken into consideration. So I'll explain that a bit further now. So the groups are Group A, B, and C. Here we can see Group A is for a son or daughter, minor of a deceased child, or favourite niece and nephew, okay? And the threshold for that is 400,000. If you are a linear ancestor, descendant, brother, sister, niece, or nephew, the limit or the threshold is 40,000, and any other person, the threshold is 20,000, okay? So that means that you can receive from any of these people, depending on the relationship, that amount tax-free. And anything after that is taxed at 33%, okay? So we need to figure out now how Brendan is going to claim agricultural relief. So what is agricultural relief? So that's the main relief used in farm transactions, but it reduces the taxable value by 90% of its value before comparing the relevant tax-free threshold. So the last section in that sentence is very important because it's before comparing to the relevant tax-free threshold, okay? So there is conditions to this. So the financial farmer test is one of the conditions, okay? So 80% of the transferee's assets must be classed as agricultural. So Brendan, who is going to be taking on the 27 acres, his assets must be, his agricultural assets must be 80% or more than his non-agricultural assets to avail of this relief. The active farmer condition is both the donor and beneficiary or leasee must have an agricultural qualification or must commit to spending 50% of their working time. This is to avoid the clawback and must retain the assets again for 6 years. So Brendan cannot sell the land. He must retain it in his name for 6 years. So an example of this is in Brendan's case. So how do you know if his assets are going to meet the 80% test? That's the first thing. So the value of the assets that are being transferred, we know, are €220,000 for them 27 acres. But he also holds non-agricultural assets of 30,000. Okay, so this may be a share in a house or something like that. So when you add them two together, it gives you 250,000. Is it more than 80%? Is 80% or more agricultural assets? And in this case, yes, 88% of them are classed as agricultural. So he can avail from agricultural relief. So the active farmer condition. So to meet the active farmer test, the beneficiary, so that's Brendan, must either have an agricultural qualification, which he does. He has his green cert. We stated that at the start. But if he didn't, he could commit to farm the agricultural property for at least 50% of his or her normal working hours, okay? So what does that mean? So as we know, Brendan is in full-time employment off farm and he works in construction. So say Brendan worked a 40-hour week. That was his normal working week. So 50% of that would be 20 hours. So Brendan would have to show that he can work 20 hours a week on the farm. So what would that mean? Would that mean on a Monday to Friday, he'd work an hour in the morning and evening? So that would be his 10 hours. On a Saturday, he might work 8 hours, you know, doing jobs around the yard and things like that, looking after cattle, dosing, herding, all that kind of thing. And then on Sunday, he would also do an hour in the morning and an hour in the evening, or 2 hours in the morning, depending, okay? And that would show that you can prove that you've 20 hours of work on the farm, okay? If also he didn't want to, couldn't avail of that or couldn't prove that, what you could do is lease it to someone who satisfies either of the above criteria. So either they are farming and can show that 50% of their normal working time goes towards farming, or they have a green cert. So if Brendan initially didn't want to farm, he could lease it to somebody currently, okay? But this must be for at least 6 years. So capital acquisitions, other reliefs. So what is another relief? So everyone gets a small annual gift exemption of €3,000. There's business relief, which is very similar to agriculture relief, but you're depending on it's better for, it suits people better that have non-agricultural assets, a lot of them. And then there's favorite nephew and niece relief. Okay. On that, we're not going to get into all the conditions on that, but if you are a favorite niece or nephew, our advice would be to you is to speak to your uncle or aunt and get a plan in place, because you will need proof, 5 years proof to the revenue that you are the favorite niece or nephew. And now is the time, even if you're not thinking of transferring it for another 5 or 10 years, now is the time to start that planning process or have a plan in place. So it would be advisable that you speak to your uncle or aunt or to your niece or nephew, depending on where you are, and then go to your accountant and have a discussion with them that maybe you want to transfer to a niece or nephew, and what do you need to do in order for them to classify as a favourite niece or nephew. Stamp duty. So from the stamp duty side of things, it's potentially liable on the transferee. So that is Brendan, where the transferor, his mother, gives him a lifetime gift. It does not apply in inheritance. Okay. Where stamp duty applies, it is calculated on the total land and buildings received. It does not apply to direct payment entitlements. So the rates of stamp duty are currently at the moment 7.5% on non-residential assets such as farmland and buildings. Residential property, so the first million is up to 1%, and then anything from 1 to 1.5 million is at 2%, and anything after that is subject to 6% stamp duty. There are reliefs available though. So in this case, Brendan, who's 33, the transferee must be under the age of 35. Okay, so this is for a young trained farmer relief. So for the relief at the time of transfer, they must have achieved the level 6 qualification. And in this case, Brendan he has his green cert. They must also have a business plan certified by Teagasc. Okay. So the business plan is, as Ruth has already mentioned, is the My Farm, My Plan book. You would have completed this as part of your green cert. So if you have your green cert you will be very familiar with this. In order to get this certified by Teagasc, you just ring your local office, and there's somebody in every region that certifies these plans. All you have to do is speak to the person that certifies the business plans. You'll be directed to them, and they will instruct you how to go from there. The transferee applicant must actively farm the land for 5 years after the claim. So if you avail of this relief, you cannot lease the land out. Okay, you must actively farm yourself for the 5 years. It is only available though until the end of 2025. I will put asterisks at that as well. It usually is continued on every year in the budget, so just keep an eye on that. So this will give you a 0% rate of stamp duty if you want to avail of this of young trained farmers. So it would eliminate stamp duty completely. Okay. But if you are in a position, and maybe Brendan, if we take him as an example, didn't actually want to go into farming straight away and didn't want to actively farm the land for 5 years, what could he do? And what he could claim instead of young trained farmer relief is consanguinity relief. Okay. And this is why I mentioned it at the start. So consanguinity relief applies where the transferee is as a blood relation from the transferor. So in this case, it's from mother to son, so they are blood relation. It imposes a maximum potential stamp duty rate of 1%. The farmland only must be actively farmed after transferring by anyone. So what this means is that Brendan then can lease it out to somebody if he wishes. Okay. There's no age limits on either party to the transfer at present. It's currently available until the end of 2028. And again, it's reviewed in the budget every 3 years. In this case, the son, so Brendan, needs to keep an eye on this for the balance of land due in 5 years. So remember that Brendan is now only receiving the 27 acres from his mother. There is, I think, a 45-acre block then from his father. So it's to be aware of this, that if Brendan goes over the age of 35, consanguinity relief is what he will want to avail of. But it is only available currently at the moment until the end of 2028. So we will have to watch that and make sure, or maybe do an earlier transfer to avail of it. It is reviewed every 3 years. So 2028 is current, but it may be extended. So to explain all the transfer or the stamp duty reliefs here. So we know the 27 acres was valued at 220,000. That currently is at a rate of 7.5%, which would be 16,500 that Brendan would have to pay. On consanguinity relief, it would be reduce the rate down to 1%, so it would only be €2,200. And if he claims young trained farmer relief, it's zero. So that's where that's why I was mentioning, if Brendan didn't want to farm that land actively, he would be better off paying the €2,200, and then he wouldn't have to farm it himself for 5 years. He could lease it to somebody. So you may be better off claiming the consanguinity relief. But if he wants to farm actively, young trained farmer, as long as you're under the age of 35, is the way to go. So the proposed block or the land transfer in 2029. So if you remember, they suggested at the start that they were going to transfer the remaining block of land, which is the 48 acres, in 5 years' time. So that would have been valued at about $500,000, and the rate of 7.5% would impose a tax bill of 37,500. But if it's still there when in 2029, or they may have to go a year earlier in 2028 to avail of consanguinity relief, 1% would be a tax bill of €5,000. So this is why planning for your taxes is so important. So again, Ruth has already mentioned it in her presentation, but I'll just mention it again because in this case, this family went into a multi-herd partnership and they did receive the maximum grant, okay? So this is the succession planning advice grant, which they got because they were part of the teams in Teagasc. And then they also availed of the Registered Farm Partnership grant. Both grants of 50% aid, and they've a max payment of €1,500. These grants are done through your solicitor and accountant, and as Ruth has already said, you get an invitation from the department to apply for them around August time every year if you are successful in forming a registered farm partnership. Yeah. So top tips on the succession and inheritance side of things would be talk early and talk often. If you're not going to transfer now, that's fine, but at least have a plan, at least have the plan in your will, so that God forbid if anything ever happened, it's all there and it can be divided as you wish. Maximize these reliefs. So you would have seen there would have been hefty bills, but when we maximize the reliefs, it minimized the tax bill. But don't let the taxes completely dictate what's right for you and your family when it comes to farm transfer. And that's where I use the example of, instead of maybe claiming the young trained farmer relief in stamp duty, maybe claiming consanguinity relief and paying that €2,200 might have been better for Brendan if he didn't wish to farm when the land transferred. Okay, if you need any more information on any of these, and again, like James has stated, this is recorded, but if you scan the QR code, it will bring you to the farm transfer side of the Teagasc website, and all the information that you require is there. And there is all webinars as well from the transfer of the family farm events, which goes into more detail on all these taxes. So thank you very much.
Thanks, Klara. And while you're getting your breath back, maybe I might start with some of the questions, and I'll aim at Ruth. So I'll start you off, maybe Ruth, with a simple one.
Yeah.
So in a registered farm partnership, and when you're dealing with the Department of Agriculture, and maybe there's a couple of herd numbers involved, where does the correspondence go? Does it go to one person or to both people, or is it separated by herd number? How is that handled? So for people that are used to...
When you submit your partnership application, that's done under an email address, and you will have registered the relevant email address that you wish all correspondence to come through going forward. So it'll be through that email address that the partnerships office will correspond with you.
And then on the say the ag food system, if there's correspondence relating to your BIS application or any of the other schemes, how...
So it'll be related. assuming that there's a partnership name, that there will be a name and address that's assigned to the partnership number, and it'll all be done through that. So if there's written correspondence, it'll go through the address that you specified at the time of registering the partnership application. Or if it's correspondence, and a lot of the correspondence now, to be fair, comes through the email address. Or alternatively, they will log into their partnership file up on the Department of Agriculture, and their correspondence will be through the partnership account on the Department of Ag file.
All right, okay, very good. In relation to a young trained farmer joining an RFP, how is the higher rates of BIS? That's through a scheme, is it?
So the BIS application and the complementary income support for young farmers is basically a top up on the existing hectares that you have declared on your application. So if it's up to a maximum of 50 hectares. So if you have 40 hectares, you only get it on the 40. If you have 60, you only get it on the 50. So it's a maximum of 50 hectares, and it comes as part of your payment for your BIS payment, and it comes for a maximum of 5 years. Now, if you have a multi-herd partnership and you have a young trained farmer on one herd number, he will receive it up to the maximum on his herd number. But if there is entitlements left over, they can then move to a top up on the other herd number, so it gets to the maximum of the 50, assuming that nobody else on the other herd number previously received a payment since 2015 for that scheme.
So if there's 50 hectares there, it doesn't matter what herd number, they'll try and max the payment anyway.
Yes.
Yeah.
Yes.
I'll ask you one more straightforward enough question, and then I'll ask Klara one. The profit sharing ratio, can that be changed over the lifetime of the partnership, as the roles might change as maybe one generation gets older and another generation has maybe more responsibilities with family and stuff?
Yes, and that's often what will happen, is that it may start off at an 80-20 split with the younger generation on the 20. And as the land is transferred and the responsibility and the roles change on the farm, the profit sharing ratio will generally change in line with that as well. It is a requirement as part of your partnership application that if you do make changes like that to the partnership, that you just send in an updated partnership agreement to the Farm Partnerships Office. So it's just a copy of the updated agreement reflecting the change then in the profit sharing ratio. But it's not an issue at all for that to change during the course of the partnership, and you'd expect that would happen.
Okay, thanks, Ruth. There's lots of questions here. Most of them are for you, Ruth, but if you break for a second, I'll ask Klara a question. In relation to the example, there was a site going from parent to daughter.
Yes.
If it happened that didn't transpire, and Brendan, the son, was to give his sister a site, what's the implications there for the tax?
Well, Brendan, firstly, if it's, say Brendan decides to give Julie a site, the sister a site, in 5 years' time, there's capital gains tax on Brendan's side, okay? But then from Julie's side, this is where the thing gets a little bit complicated. So remember where the thresholds were regarding capital acquisitions tax. So from a transfer from a brother to a sister, the threshold is only €40,000. So if the site is valued at over that, there could be a bit of a tax bill for Julie on that. But also she is subject to stamp duty as well. So you would have to look at that with your accountant to know exactly how much and try and see if there is any reliefs. But Julie would have to pay a nice bit of tax as well. So they both would from both sides on that side of thing, because it's from a brother to sister. Depending on the value of the site, if it's very high value site, there would be a bit of tax involved in it, definitely.
I was just thinking there, and if Julie got property already from an aunt, and they're the same category, so she might have her life limit already used up. So if the site was to come from her brother, the value of the entire site might be fully taxable at 33%. So
exactly, So I forgot about the house that she received from her aunt. So the threshold might be well used up, that 40,000, and more than likely, if it's a house, it probably is. So she'd be liable on 33% plus the stamp duty rates. And Brendan, depending, I suppose, on when it was transferred, the capital gains tax on that site.
So the lesson there is, if sites or there's settlements to be done, it's better that the gifts come from parents to child rather than sibling to sibling.
Absolutely. And if there's an inclination that parents are going to give a site to the child, they stated in a will, or hold on to them few acres that they wish, and if they don't decide that they want to build there, that's fine. Then transfer to maybe their farm successor later on, either in a will, leave it in their will that it goes to the successor, or if the daughter wanted a site, that would be a more efficient way of doing it. Because transfers from siblings, there is good few tax implications with it. The thresholds aren't there.
Yeah. Another question, this one relates to consanguinity relief. So if land is transferred from father to son and the son avails of consanguinity relief, can the father just continue farming the land to qualify for the active farmer point of view?
Yeah, because it's consanguinity relief. So the person who received that land doesn't have to actively farm it, but somebody does have to. So as long as they meet one of I'm thinking of the capital acquisitions tax, but they don't have to actively farm it if they didn't claim young trained farmer relief. So yes, the father can continue to farm it. That's fine. That's no problem. But they must retain the land in their name. So the folio in their name for at least 6 years.
Yeah, and probably a 6-year lease between father and son is probably...
It's the safer bet, yes. It takes out the complication out of it, yeah.
I'll come back to you, Ruth. Can a young farmer claim the young farmer entitlements and the main farmer continue to get BPS as normal?
Okay, so what happens is if you have, in order for the young farmer to be eligible for that, he has to be listed on the herd number. So they would either be on a herd number on his own, or he'd be on a joint herd number with the father. And therefore, they get, the young farmer scheme is actually a top up on the entitlements. So if the father has entitlements on all the ground already, the young farmer scheme would be a top up on those. The National Reserves only gives entitlements if you have naked ground, so you can't double stack entitlements. So if there's entitlements already on the ground, you won't get a second allocation to put on top of them. So yeah, there's two different schemes. There's the National Reserve and the Complementary Income Support for Young Farmers. And one is a top up, which you can get on the 50 hectares. And the other one is either that you get entitlements for naked ground or you bring below average ones up to the average. But if you already have a full set of entitlements and they're all above the average, you won't get anything from the National Reserve.
Thanks, Ruth. I'll take 3 more questions and then we'll finish up as it's getting late and we're well over an hour on. So the next question is, if a child is transferred land now, do they have to farm it straight away to avail of stamp duty relief, or can it be left in their father's herd number and avail of stamp duty relief down the line?
So if it's transferred to the child, they would be subject to capital acquisitions and stamp duty. So on the stamp duty, yes, they'd have to pay it, but it depends on what relief they avail of. If they avail of the young trained farmer relief, they have to farm it themselves actively for 5 years. But if they claim consanguinity relief, they don't have to actively farm it themselves. The father can still farm it in the father's herd number. And like we said in the previous answer there, maybe set up a 6-year lease with the father and pay the 1% rather than the 0 so that they can do that. Yeah.
Thanks, Klara. How does stock relief work? So Ruth, will I aim that one at you? See, you're the one that mentioned it in your talk.
So what they do is in relation to your accounts, they take the value of the stock at the beginning of the year and they take the value of the stock at the end of the year. And it's the change and the increase in the value of those that could be subject to tax. So you're allowed to have a 25% increase, but you can have a significantly bigger increase if you're within the first 3 years of going on the herd number. So we call it that the young farmer stock relief rate. And where I went through on those examples there, that young farmer can get up on 100,000 of a stock relief with a maximum of 40,000 in any year. And I suppose the benefit with the partnership is that normal 25% for the other partners is increased then to 50%. So that's how the stock relief works. So it's based on the change in the value of the stock from the opening of the year to the closing of the year.
Yeah, and so from a taxation point of view, extra animals on the farm is almost, if the value of the stock has gone up, is seen as extra profit, so it's taxable. but the money isn't in the bank account, so you have to pay the tax. So the relieves that pressure, I suppose. With a registered farm partnership, and it's just in relation to if a partner dies, what happens? So I suppose it might depend on the number of partners there, but you might explain that, Ruth.
Yeah. So look at officially, if a partner is deceased within a partnership, it requires the partnership to be dissolved. All of those cases are dealt with on a case-by-case basis, and they have a unit within the department that specifically deals with this. But in relation to the registered farm partnership, the partnership would be dissolved if one of the partners was to die, but they may have the option to reform a new partnership if that's something that they wish to do, assuming that they were able to meet those requirements. Now, where we have maybe a parent and a child in a registered farm partnership, and if one of the parents dies, it may be an option if the other wasn't already previously in, that the other spouse could possibly step into the shoes of the mother or father that has since passed, and that they would allow them come in as a Category 1 applicant, although they may not have been listed on the herd number. But look, that would be dealt with on a case-by-case basis with the department, but there is concessions made in relation to that. In addition, if it was to happen within the 5 years of getting TAMS funding and the partnership had to be dissolved, that's deemed as force majeure, and therefore there wouldn't be any clawback where a partnership was dissolved under those circumstances.
Yeah, it's a common enough one, and I've come across a few cases of that over the last number of years. And I think the final question, Ruth, I'm going to ask you is in relation to the TAMS grant. So if a lady is 49 years of age and can she become a Category 2 partner and claim the 60% grant? Is there an age limit there on that?
So in relation to the women's scheme, they have to be under 67. For a Category 2 applicant, they have to have a recognised agricultural qualification. So unless they have an agricultural qualification, they won't qualify as a Category 2. But if they were already on an existing herd number for 2 years, and they were on that herd number in 2022, on the BPS application in 2022, they would meet the requirements for the women's scheme. If they're in a registered farm partnership, the way that it works in relation to the women's scheme is that they would get the first 90,000 of the 160,000 ceiling at a 60% grant rate, and then assuming that there isn't another woman within the partnership that meets those requirements, the remaining 70,000 would then be at the 40% grant rate.
So if you don't have the 2 years, you could go and do the green cert, and then
you could, yes. So
yeah.
you have 36 months then to obtain the qualification afterwards, but you don't get paid the additional 20% until you have the qualification completed.
Okay,
yeah.
Very good. So just finally, I'd like to thank Ruth and for organising the event tonight, and for Ruth and Klara for speaking tonight and making presentations and answering some difficult questions. I'd like to thank you, the audience, for your participation tonight and sending in the questions. I didn't get to all of them, but I think it might take another 20 minutes if we were to do that. So
James, just to mention, if there's questions there that haven't been answered, I'll be able to pick them up at a later stage and can get back to the email address that was registered with the questions. So if anybody has a question that wasn't answered and they're still looking for a response, we'll try and get back to those outside of the conference call.
Yeah, outside of that, and failing that, maybe they could chat to their local advisor or make contact with us directly. Finally, if you want to review the material, it'll be up on the website in the next couple of days on the Teagasc YouTube channel. And if you are looking at it next week and you have further questions, contact maybe your local advisor. It would be your first port of call. And if they don't have the answer, they can contact us as necessary should they need additional advice in dealing with your queries. So thanks all for participating tonight. Thanks to Klara and Ruth, and wish you good night, and thanks again.
Thank you.
Thanks.